You work hard, spend less, and lock your cash away in a savings account. For most of us, this is the definition of financial safety. But while that money sits untouched, the world around it changes, and the currency begins losing its power. Blindly seeking the lowest price and refusing to spend money feels like discipline. In reality, these habits often function as psychological traps rather than mathematical strategies for growth. This creates a contradiction. Many of the behaviors used to save money are the same mechanisms that prevent the accumulation of long-term wealth. Financial security requires an understanding of the invisible forces that cause stagnant assets to leak value over time. Buying the cheapest available item provides an immediate dopamine hit, but that bargain comes with a predictable timeline. The product eventually fails, sending you back to the store to spend again. This chart tracks the compounding damage of that cycle. When we map a $20 item replaced every 6 months, the cumulative expense quickly surpasses the one-time cost of a $100 premium version. This logic extends to your time. Spending hours clipping coupons to save a few dollars trades a non-renewable asset for a negligible financial gain. Refusing to pay for expertise traps you in low-leverage tasks. Doing the work of a bookkeeper to avoid a fee can cap your earning potential by distracting you from higher-value opportunities. Obsessing over the initial price tag creates a persistent drain. This approach trades future wealth and current energy for the illusion of a bargain. These panels show cognitive biases cause us to misinterpret risk. Our brains are wired for short-term survival. Loss aversion is a primary driver. The psychological pain of a loss feels twice as heavy as a gain, forcing people to hold declining investments out of fear. This diagram illustrates how individual glitches scale. Herd mentality overrides logic with social proof, driving market volatility. Overconfidence bias convinces casual savers they can predict market movements without a strategy, leading to excessive trading and transaction costs that erode returns. Every financial choice is influenced by these primal glitches. Until you recognize them, your decisions will be driven by evolutionary instincts instead of math. An active force in the economy reduces wealth without touching your bank account. Inflation acts as a leak at the bottom of your savings bucket. This chart demonstrates the impact on purchasing power. While the nominal balance of $10,000 stays the same, the actual goods that money can buy become shorter every year. A saver views a static bank account as safety, but an investor sees the economy is designed to punish stagnant capital. Holding cash is like standing still on a downward escalator. Without making a mistake, you lose ground because the environment moves against you. In this environment, traditional saving is a guaranteed path to a lower standard of living. Safety without growth leads to a loss of wealth. To break the cycle, you must differentiate between being cheap and being frugal. Cheapness allows the lowest price to dictate every choice. Frugality optimizes for long-term value and quality. Budgeting usually fails because it relies on willpower. A conscious spending plan replaces that effort by creating a structure for your income. This model shows the 4 pillars of a conscious plan. You systematically allocate for essentials and investments first, which makes the remaining guilt-free portion available for the things you actually value. Total automation removes the need for constant discipline. Digital systems route money to investments on payday, securing the future before cognitive biases can intervene. Firm financial control comes from engineering a system that automatically funds your priorities rather than agonizing over daily deprivations. Building wealth requires a shift in perspective, treating money as a tool to be deployed rather than a trophy to be hoarded. Converting cash into assets, like stocks or real estate, transforms static numbers into multiplying streams of income that grow independently of your time. This involves rewriting your internalized money scripts. Instead of focusing on cutting minor daily expenses, you maximize major earning and investing opportunities. Wealth is the result of movement and leverage. Stagnant money shrinks, but capital that is put to